Hello friends.
Hello sir.
So in our earlier session what we've understood is we talked about revenue, right?
Yes.
And when we talked about revenue, what did we say? That revenue is recognized when
It is probable that it will lead to inflow of economic benefits.
perfect. So when we said that the probable future economic benefits will flow to the enterprise, and we said that it should flow in the ordinary course of the business, right? Let's take a step forward. These two should result in the increase in equity. Remember, if you make the profit and loss account, where would you find revenue? On the credit side, right?
Yes, sir.
This revenue would lead to an increase in profit. Correct? And where would this profit go? It would go as an increase in equity. Correct? So this is where the revenue would find place or have its impact. So when we talk about revenue, this should result in increase in equity. Okay? But there can be an increase in equity even when you contribute share capital, correct? But would that be revenue?
No.
Why? Because we talked about 5 conditions which must be satisfied. We said that revenue can be in only 3 forms: sale of goods, rendering of services, and use of entities' resources, leading to interest, dividend, royalty. Capital contribution does not fall into these, correct? So therefore, this would be other than by contribution from equity participants, and equity participants are shareholders. So this would complete the definition of revenue for us, correct? So revenue is something that leads to gross inflow of probable future economic benefits in the ordinary course of the business that results in an increase in equity other than by contribution from equity participants, correct? Now we have seen examples where we said that I have sold goods. The sale price of the good was 100 rupees and I have charged 10% VAT on that. So the total amount that I receive is 110 rupees, correct? So sale price rupees 100 plus VAT at the rate of 10%, rupees 10, and I receive a total of 110. Okay? Now what would be my revenue? 110, because this is what I am getting. But remember, does this 110 belong to me?
No.
What is the amount that belongs to me?
100.
Rupees 100, correct? The 10 rupees that I have got here, I have only collected it on behalf of the government, and I will have to deposit it back to the government. Right? So IFRS categorically says that the revenue will be only rupees 100. The amount that I have collected on behalf of any other party, example sales tax, VAT, service tax, etc., is not part of my revenue. Okay? Are we clear?
Yes, sir.
Any questions?
No, sir.
What we will now understand is, remember when we said that how is India reacting to IFRS, and we said that India is adapting to IFRS. and accordingly we've come up with something called Indian Accounting Standards, IAS. So we will have a very brief understanding of the differences between what the Indian GAAP says in terms of revenue now, what is there in IFRS and what is there in IAS. Okay? So whatever we've discussed in terms of revenue so far is as per IFRS. Now, broadly speaking, there is not much difference between what is mentioned in the Indian GAAP versus what is mentioned in the IFRS. And please note that for this point, whatever is there in IFRS, it's the same in case of IAS as well. Okay? Now, when we talk about Indian GAAP, there are at least two things that comes into play. One is the accounting standard, which is AS 9, which talks about revenue recognition. The other is there's something which is mentioned with respect to revenues in the Companies Act. Okay? So it's given in your books and you can refer to that accordingly. The next important point in terms of differences between IFRS and Indian GAAP is the Indian GAAP talks about recognizing revenues in terms of the money that we will receive. That is the nominal value. Can I read this part?
Yes, sir.
So the Indian GAAP versus IFRS, it says the revenue will be recognized at nominal value. What is the value that I will get? Okay? Whereas the IFRS says recognize revenue based on fair value. Remember we took an example where you had subscribed to a 2-year program. The 2-year program, you have already subscribed to it. The company has received the money. It is for 2 years. What is the nominal value of money that you will get? 1 lakh. What is the fair value of money or fair value of services that you've got? 50,000. So IFRS will say record it at the fair value. Indian GAAP will say record it at nominal value. Now there will be considerations around it and we are not getting into details, but as a brief overview, the Indian GAAP talks about recording revenues at a nominal value, whereas IFRS talks about recording revenues at a fair value. Okay? The IAS is similar to IFRS. Okay? Now, this is a critical part and we need to understand this carefully as to how do you account for revenue in terms of fair value. Okay? Now, let's take an example. You sell an item, right? And there's an example in your book itself where we say that A Limited normally sells goods at a price of rupees 1,20,000. Okay? So the sale price is rupees 1,20,000. If there is a situation where somebody comes and tells you that I want to buy these goods from you, but at the same time I will not be able to pay the amount immediately. You negotiate that, okay, you pay rupees 1,40,000 after 6 months. Okay? You pay after 6 months. Now you have sold a good and you know that you will be getting 1,40,000 rupees and you will get it after 6 months. Now this 6 months is not your normal credit terms, okay? Let's assume that. So what will be your revenue? What will be your sale, income from sales in this case? 1,20,000. 1,40,000. See, logically speaking, you may say that, sir, I have sold the item. I could sell it for 1,20,000. I could sell it for 1,40,000. Doesn't matter because I've sold the goods, right? By and large, all the 5 conditions of my sale of goods is met. I know that future economic benefits is 1,40,000 rupees. I am transferring the risk and reward. I am not maintaining any control over it. I know the cost of my product. So if I look at it from the 5 points that we discussed, 1,40,000 is also right. But what IFRS says is, remember when we talk about the fair value principle, IFRS says that what is the fair value of your sales? The fair value of your sales is 1,20,000. Because if it was for any other person, if the person would have bought this good from you right now, sorry, you would have got rupees 1,20,000 only. So the fair value of this good is rupees 1,20,000 only. What you will get after 6 months is 1,40,000. So effectively, 40,000 is 1,40,000 minus 1,20,000. That is rupees 20,000 is your financing arrangement. And this amount must be accounted for as interest income. Okay? Now this is very, very crucial. We've talked about something called effective interest rate, effective interest method, and there is something called imputed rate of interest. If we take another example, if you did not know that you would get 1,20,000 rupees, if the only thing that you knew was the person will pay you 1,40,000 rupees after 6 months, let's say he was your first customer, right? You don't know what would be the sales price. In that case, what would be your revenue?
1,40,000.
Sorry? 1,40,000.
40,000.
But remember, you said that this is not your normal credit terms, right? This is not your normal credit terms. Would you still sell it for 1,40,000 if the person paid you cash right now? If yes, your revenue would be 1,40,000. But if no, then you will have to discount this 1,40,000 rupees to come to the fair value of these goods. Okay? So you would have to discount it to arrive at the fair value. Now we know that in order to discount something, you would need a discount rate. You remember from your financial management classes, time value of money, there is something called a discount rate based on which you will be able to discount it. Now what would be the discount rate? The discount rate would be the imputed rate of interest. Do you understand by what is an imputed rate of interest? The imputed rate of interest is basically a market rate of interest. It means that if you were to borrow some money from the market today, what is the interest rate that would apply to you? What is the interest rate on which you will be able to borrow this money? The same imputed rate of interest is used to discount this. So for example, if the current rate of interest is 12%, you would discount rupees 1,40,000 at the rate of 12% for 6 months. Okay? So the calculation would have been 1,40,000 divided by 1.12 to the power 0.5. 0.5 is because it is 6 months, that is half year. So this is what the amount that you will get in order to calculate what is your revenue. So the amount that you get here will be the amount that you will recognize as revenue. Do we have any questions?
True, sir.
Thank you.